Welcome. Today is February 3rd. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily Five. Daily Five is the show where we take a look at the top 5 charts that we're focused on to give us a sense of what's going on in the market and where the opportunities are. So let's jump right into it. Slide number 1 really addresses the elephant in the room. Following January's 10% peak-to-trough drawdown, the question on everybody's mind is this: are we still in a bull market? Well, we've showed this chart in the past, and we made a few adjustments to the chart just given the price action that we saw over the course of the last month. But I think it makes sense to really kind of ask ourselves or redefine what a bull market is for that matter. And so let's just go through it point by point. The bull market advance is really defined by a sustained uptrend. And the question is, do we still have a sustained uptrend? Well, we broke the shorter term trend. There's no question about that. And we broke initial support at about 4,500. But so far, we've held the longer term trend, which we're using the 55-week moving average to define, and the 4,300 level on the S&P 500. As long as we can hold above that sustainably on a closing basis, then I think the trend remains intact. Now, another part of the definition of an uptrend is, this sense of a series of higher highs followed by higher lows. And so far, we continue to have that. Now, on a shorter term basis, we've certainly taken out the short-term lows, but we continue to hold above the intermediate to longer term lows that have been put in place. And, while typically one would define the trend by a series of moving averages, typically the 10, 50, and 200-day moving averages have been traditionally plugged in as the default levels in your computer. We're actually using a different series. We're using a Fibonacci series of 55 days and 55 weeks. And we found that historically, the 55-day moving average really does define the intermediate term trend quite well. And the 55-week moving average defines the longer term trend fairly well. And, finally, uptrend tends to be characteristic of a well-defined trend channel and clear, consolidation ranges that are bound by support and resistance. And we continue to see both of those characteristics within the market. A new trend channel is formed by the most recent low. And, we think that this trend channel remains valid until it's broken. And, certainly there is a well-defined range consolidation in place. And I think we can be, reassured by a break in either direction that the market will tell us which way it wants to go. So we're clearly focused on 4,300 on the S&P 500 as being critical support. And on the upper side, we think 4,700 is key resistance at this point. We'd like to see a breakout above that level to kind of bring us back into the former trend channel and reinvigorate the uptrend. So let's move to chart number 2 to take a different look at how to analyze the market. Now, we've shown our Elliott wave analysis over the past, and we look at it from an intermediate term and a short-term perspective. On the left side of this chart is what we're defining as primary wave 5. This is an intermediate term look, a weekly chart dating back to the lows of March 2020. And the way we see the market is that the pullback off of the highs established on January 4th, 5th was probably part of a what we'd call an irregular correction, or a double irregular flat correction for those who are very familiar with Elliott wave. And it's a 3-wave pattern where the B wave actually makes a higher high before making a new low. And if in fact this analysis is correct, then wave 4 is probably what we saw on January 24th, and that's where it terminated. And we should be back in line to see higher highs as intermediate wave 5 unfolds. Now, if we look to the right side of this chart, we can see it in greater detail. And I've actually inserted a textbook clip at the bottom that shows you exactly what a double irregular correction should look like. And if we just look above, we can see that we are exactly textbook to the penny in line with that textbook idealized double irregular corrected flat. And so we've got a lot of confidence that the January 24th low was the end of intermediate wave 4, and we are now in the midst of intermediate wave 5. That'll be confirmed upon a breakout above the 4,700 level, and then we can probably project a much higher high. And we're actually going out and saying that breakout to new all-time highs would give us the ability to count a measured move to S&P 5,400. So that's our working hypothesis right now. We continue to be bullish until the market proves otherwise by sustainably closing below S&P 4,300. At that point, we'll have to shift to the alternate count, which would be a bearish version. We're not there yet. So let's move on to slide number 3 and look at some more supporting evidence. In the past, we've talked about breadth divergences, and we've used it as a way to identify tops in the market through non-confirmations. Well, here we are looking just at the S&P 500 advanced decline line. In the past, we've talked about the New York Stock Exchange a composite AD line, which is the broader version of this. If we confine it to just the S&P 500's issues and compare it to the S&P 500 itself, which is in the bottom frame of this diagram, you can see that as the S&P itself made its January 24th lows, the S&P's advanced decline line actually made a higher low. And so in the past, we've talked about these negative divergences highlighting a top in the market, or warning of a top in the market. Well, positive divergences give the exact opposite signal. They highlight of an impending rally ahead. So, what we're looking at here is that, the advanced decline line actually broadened out on January 24th relative to its December low, its prior low. Whereas the S&P 500 in price terms made a lower low, the AD line made a higher low. And so that positive divergence gives us an indication that the market is washed out and ready for at least a reflexive bounce of some sort, if not a recovery to the bull trend. And at this point, we feel that there's a high probability that this is supporting that shift back into a forward momentum, a forward progress, if you will, on the S&P 500's bull market advance. So let's take a look at chart number 4 to get another look or explanation as to what might be going on in the market. And what we're looking at here is a ratio of the pure value to pure growth indexes. Now, the S&P's pure value index includes holdings that are exhibiting core value style characteristics based upon a multi-factor screening process. There's only 123 issues in the value index. Now, the growth index does the exact same thing, but only looks for those constituents within the S&P 500 that are exhibiting core growth style characteristics based upon that multi-factor screening process. At this time, the core growth index has only 57 issues. What's important is that their pure growth and pure value, there is absolutely no overlap between these two indexes. This is in stark contrast to the Russell growth versus the Russell value indexes, which hold exactly the same stocks, but have different weightings in those stocks. So here we're purely looking at those stocks that are definitely value stocks versus absolute growth stocks. And so the ratio itself is examining the relative strength between the two. And so as the dark line is descending, we see growth outperforming value. And when the dark line is ascending, then value's outperforming growth. Well, what we've seen here over the past 2 months or so is a substantial recovery in value relative to growth. And so there's an underlying shift within the index itself from growth to value. And value tends to be represented by financials, by energy, by industrials, by basic materials, things of that nature. There's actually certain stocks in every sector that can accommodate those factors that are necessary to become a pure value stock. But the essence of it is that you've got to shift away from things like technology and discretionary and into things like materials, energy, and financials. And so as those sectors continue to exhibit strength, we would expect the pure growth ratio to further its breakout. When we look at the lower frame of this chart, we can see that structural momentum is actually already broken out above its 2021 high, which leads us to believe that the initial breakouts that we've seen again above trend resistance and moving average resistance will likely continue to resolve above what we would describe as chart resistance given the 2021 highs. So let's keep our eye on this relationship, value versus growth, re-exhibiting its relative strength. And if that continues, we would expect that to further support the idea of a final upside move to the long-term bull market advance. So let's take a look at chart number 5 to get a sense of what's actually driving the market here. Well, on the left-hand side of this chart, we can see that there is a clear, leadership being exhibited by the S&P energy sector. And here we're looking at the 11 different S&P sector spiders. And there's definitely a shift to the upside in terms of defensives, staples, utilities, real estate are all kind of showing up in the leading quadrant, which indicates that there's relative strength leadership amongst those sectors. But by far and away, the energy sector is the head and shoulders leader above all the others. And we can clearly see that tech and discretionary have lost a great deal of their momentum and are actually negative in terms of momentum and are moving from right to left, which is an indication of losing relative strength leadership. And we can also see financials are making a strong move to the upside in terms of their momentum and are appear poised to cross over into the leading quadrant in the near term, along with healthcare. So these are more value-centric, defensive-centric entities, and we would expect that just given the sort of volatility that we've had in the market. But we wouldn't expect energy to be leading. There's something different going on here. So let's take a deeper dive into the energy sector itself on the right-hand side of the chart, and we can see that the leading stock is Haliburton. And so chart 5B actually takes a deeper dive look at Haliburton's setup. And Haliburton is really the strongest stock in the strongest sector, which in some respects makes it the strongest stock in the S&P 500 right now. And what we like about Haliburton is the stock appears to have resolved above a classic pattern-based formation of the inverted head and shoulders variety. And that pattern tends to resolve substantially to the upside in proportion to its base, which is extremely deep. That's a base of about 20 handles, and the breakout above $25, which was key resistance or the neckline as technicians might refer to it, if sustained, projects a measured move to approximately $45 a share. That translates into greater than 40% potential gain, actually almost 50% from where we're at now. And so we think there's a lot of upside potential here. And when we couple that with the relative strength characteristics, its overall leadership gives us a lot of confidence that the opportunity exists for investors to position confidently in Haliburton. Now, we want to protect our downside as well here. So, we would advise an initial stop loss set at about $26, which, would be just above the neckline and would actually limit your risk to about 5 handles, which establishes an attractive 3-to-1 positive risk skew. So using an entry price of about $30, and a profit target of about $45, stop loss of about 26. With a risk skew of 3-1, we think there's a great opportunity in Haliburton shares right now. So that pretty much sums up our view of what's going on in the market and where we think the opportunities are. If you want to contact us or discuss it further, feel free to reach out. You can contact me through my website at jwhinvestment.com, or you can find me on Twitter at alpha_insights, or just send me an email, jhuge@jwhinvestment.com. I wish you guys the best of luck trading. Thanks a lot for watching today.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.